Good morning, everyone. Thank you so much for joining us in our Startups in London Libraries session on how to get your head around the numbers. Your hosts for the next half an hour are myself, Ioana Limberaki. I am the SME champion for Bexley, and Rashid Belal, my friend and colleague and champion from Newham. Our main aim for today is to demystify numbers by showing you two important tools that will help you build a successful business. In the time that we have available, because it's not a lot, we will be focusing on your cash flow and your profit and loss account, because they are an excellent starting point into getting your head around the numbers. But let me take a step back and start by talking a little bit about the reasons why startups and early stage businesses have not been focusing enough on their numbers. When you ask people to tell you what they think about numbers, people might say that they hate them, and they might say that they love them. I personally love them. People also describe them as scary, as incomprehensible, as difficult to understand. We are here today to remove all those fears or myths around numbers and focus on what is essential. And if you understand why you need to look at some numbers and how to look at them, I am sure that all your fears will go away. I think people are fearful because of many reasons, but mostly because there was a notion for many, many decades that numbers were important only for big businesses. And I'm pretty sure that you have heard a lot of people say, oh, I only have a very small business. I don't really need to know that much. Or, oh, I have my accountant to let me know what is happening in my business. At the same time, the literature hasn't helped because for many years, it was focused mostly around the numbers and the needs for big businesses. And it was very difficult for someone who was starting a small business to understand what was really necessary to know out of all the literature that was available. At the same time, it is also true that until a few years ago, it was really expensive for an early stage startup or a startup to have systems in place to generate the information that they needed in order to have a look at their numbers, which is no longer true with all the software that is available at the moment in really good prices. But on top of all of that, I think there is something else also. There is a certain level of shyness, a certain level of shame sometimes when we are talking about numbers. But in reality, what you want is to be bold with numbers. You need to know your numbers. You need to understand them, and you want to own them. This is the only way that you can build a successful and sustainable business. So why is it then important to know your numbers? It is important to know your numbers for two very specific reasons, as far as I'm concerned. First of all, because it's the numbers that will tell you whether your business model is profitable. If you're not making profit, then you do not have a sustainable business. And that is a fact, and I'm sure that you all understand that. Secondly, you need to know your numbers because you need to know that you have the necessary cash to run your business. And believe me, you can have profit, but not enough cash to run your business. So being on top of those two things, having a profitable business and having the necessary cash to run your business removes the uncertainty around your future and lets you focus your energy on running and growing your business, which is the important thing. Now, today, as we said, we will focus on cash flow and profit and loss. We will try to understand them and see how we can use them in order to have a sustainable business. We will start by looking a little bit on costs and try to remember the different groups of costings. Then we will look at the initial budget that you need to prepare as a startup. We will then move forward onto a forecast cash flow and see how we can set it up. We will use a small example to understand. No, and then we will look at how important it is to check your forecast cash flow against the actual, what has actually happened in that month or in that period that we are looking for. Then we will look at a very small example in order to understand all of this. And then Rashid will join us and talk to you about profit and loss and why that is important and how to get your head around profit. So the different cost structures. Just a little reminder, we have three different types of costs that we are normally talking about. The first one is our variable costs. Variable costs are exactly what the name says. They are variable, they are changing, and basically they are changing because they are directly in relation to the sales that your business makes. Now, these type of costs usually involve the raw materials that you have used in your production process if you're producing products, goods that you might buy in order to resell or to incorporate it in your final product, subcontractors that you might have for a specific product if you are in the services sector. Then you have your fixed costs. So your fixed costs are standard costs that you have that you incur on a monthly or a quarterly basis, and these might include wage and salaries. It might include rent. It might include insurance, business rates, utilities. All that type of costing. And then in the end, you have capital costs, which relate to the purchase of physical business assets, like your computers, machinery, buildings, a vehicle for your business. They usually occur less frequently than fixed and variable costs, and they affect your cash flow and your profit and loss in a different way. And that's why it's also important to mention them and look at them. Now, when you are starting a business, the most important thing to do, and it's your first step, let's say, is your initial budget. You really need to sit down and write down all the costs that you need to invest in your business in order to get it off the ground. And I'm talking only about the upfront costs here. I'm not talking about the costs that you might have later on in order to run your business. Start with a very simple table like this, writing down all of your costs and come up with your total startup cost. This is the amount of money that you will need to invest in your business, either yourself or through investment or through a loan, but it's something that you really need to work on before you start any business venture. Now, we come on to our forecast cash flow. Now, on your screen, you will see a table that we have created for this presentation. The forecast cash flow is used to measure the total difference between the money that comes in and between the money that goes out from your business. And it's used to estimate how much money your cash will have now, later, and later on in the future. The cash flow forecast template that we have created here is for a period of 12 months. You can't see all the 12 months because we didn't have enough space on our screen. So you see month 1, 2, and then it goes to month 12. But very quickly, it will help you estimate your net cash position, which is right at the bottom, and your cash balance. Your net cash position is how much money you have left after all of your sales and all of your expenses have been paid, and your cash balance is how much money you will have accumulated through the months in your bank account. And it helps you see where you will need more cash and where you are okay with cash in order to run your business. Now, the first part of the cash flow, it's right at the top. It's the cash-ins, and that is you try to write down all the cash that you have from sales and any other resources that you might have. For instance, you have cash-ins from sales by selling your items, and you might also have other income coming in. It could be your own private investment. You are funding the business, let's say, so you are bringing cash into the business. It could be a loan that you have in order to support your business in the initial stages. It could be another private investment that might be coming in. This is where everything goes in, and you spread that over the months as a forecast in order to start filling in your forecast cash flow. Then at the bottom, below the cash-ins rather, you have all of your cash outs. Now your cash outs is everything that you pay as a cost in the business. When I'm creating a cash flow, I really like to spread the different type of costs that I have and that I will be paying in the month in different categories, because it helps me have a much clearer picture of the different cost groups that I have and how my business costs are structured. So I start by creating a group of direct cost of sales. These are the costs that are directly affected by my sales and are involved in my sales. This is materials that I have used only for my sales. This is wages, delivery costs that I might have, products that I have purchased to be resold or incorporated in my final product, merchant account fees for my sales if I have an online store and I'm accepting Visa payments or PayPal and things like that. And so I'm writing every cost that is directly involved in my sales. Then below that, I have a grouping which is other costs, where I include all my initial startup costs, and I include that in the section which says pre-startup. Following that, I have repeating costs. These are costs that come up again and again and again. They are fixed costs, most of them, like rent, like business rates, utilities, insurance, telephone and internet, marketing and advertising expenses. You will also notice that I have wages, I have salary, that is your salary or my salary if I'm running the business, and tax obligations. And then at the bottom, I have another group of costs which come in at irregular intervals. They are non-repeating costs, like equipment that I might want to purchase, which is one-off, or a salary or dividends that I want to pay myself at non-regular intervals. And I keep that separate so that I can focus on them more clearly if I need to. So at the bottom, when you add all of your cash-ins and then from them you subtract all of your cash outs, you have your net cash-in and cash-out position. And then at the bottom, your cash balance is how much money cumulatively over the months you have in the business. Now, the forecast cash flow is important because it helps you understand all your how much money you have to run your business, or whether you don't have enough money to run your business. But it's more important when you compare it against what actually happened in that month. Now, for instance, you have in this table that we have created here, a column which is your forecast, a column which is your actual, and a column with the difference. It is that difference that will help you see what went well, what didn't go that well, and what you need to work on in order to improve your numbers. And this is a very small example that we have prepared. It's a very, very simplistic example of a cash flow. Now, don't forget that when we are doing the cash flow, very important thing to remember, it's totally based on cash, which means that if you make a sale now and get paid 2 months later, then that sale will be recorded on month 2 and not now that it actually took place. The same applies for costs. So the important thing here is to look at your cash basis. One more thing to note, and it was on my previous it was here when I talked about the salary and the tax obligations. I have included the salary because I want to have a monthly salary from my business, and that's why I include it. When you start your cash flow, do try to have to include a salary for yourself. It's your motivation for running the business. I always think that it is important to include a salary from the early stages of your startup and not wait until you are a year down the line or 2 years down the line, or to think that you might be in a position to pay yourself a salary. Include it from the beginning, include it in your costing, take it into account. The second thing that I want to say is on tax. Now, there is a quick advice here. First of all, tax is something that is really, really important, all of your tax obligations, and you need to be able to know very quickly how much money you need to have in order for your tax obligations, and then at the same time when you have to pay them. And the advice here is that as you are running your business, save that amount of tax or VAT or anything that has to do with your tax obligations in a separate bank account, and use that cash only to pay for those obligations. Use it for nothing else. It is very easy to think that you will come up with that money when the time comes and you will need them. But the truth is that most businesses struggle in that respect, because in the end, they do not have the money that they need. Now, in our example here, we have our month 1 forecast against our month 1 actual. We had forecasted that we would have £1,500 in sales, cash coming in, but our actual was 1,200. So we have a difference of 300, which is wonderful to know. It's not good, but it's wonderful to know. We also have we have collected all of our data, and we have seen what our actual direct cost of sales are, any other costs that we might have, repeating costs, etc. At the bottom of our chart, we see that our cash-ins were not enough to cover our cash outs by £110. This is the first point that the cash flow actually gives you. You can see very quickly your ability to be able to cover your expenses. Now, the importance of having your forecast against your actual is that it makes you think, and that's where the numbers come in. For instance, when you have less sales, you really need to start questioning it and to start saying, have I really actually sold less? And what was it that I sold less? Was it units or was it my pricing? Could it be that some of my customers have actually taken longer to pay me, and that's why I have this difference? It is the answers to those questions that will provide you with the guidance that you need in order to take action. And action could be to improve your payment terms, for instance, with your clients. If you realize that your clients are taking a lot longer than you thought it was viable for them to pay for your products, then you need to renegotiate that. It could be that you need to look at your costs and to improve the terms that you have with the payment terms that you have with your suppliers. It could be that you need to carry less stock and try to identify how to do that. It might also be that you will need to look on your gross profit margins. Could they be too low? These are all the questions and at the same time equivalent actions that you will take by having a forecast cash flow, which you check against your actuals every month or every 15 days or every week, depending on the business that you have. And that's why it is important. It gives you a very quick overview of what has happened in terms of cash, and it gives you more detailed information both in your sales and in your costs in order to start exploring different ways of going around your business. Now, I have finished with my forecast against actual example. If there are any questions, please put them in the chat box and we will discuss them in the end. And now I'll ask Rashid to come in, take over with his presentation on profit and loss. And I will see you after that. Hi, Rashid.
Thank you so much, Fiona. Yeah, can you just change the slide, please, for me?
Of course.
Yes, thank you. So today we're gonna discuss what is profit and loss account, which is also called income statement. So as the name says, so it is basically a summary of your expenses and summary of your incomings, which is coming to your business. It can be, its standard is for 1 year, but it can be for 6 months, 3 months, or even 1 month. But if you are submitting these documents to company's house or for some sort of auditor and staff, is standard is you do it for 1 year. So invoice sales like income, they are like income nature, and salaries and advertising costs are expenses. So how do you find out how much your business is making? So it's simple, as I say, like, you got cost of sales. And if you're trading, then it should be your opening account on the date that you start the account. And then you list all the purchases, and then you deduct the closing stock. And that gives you profit before, that gives you total profit. And from there, you you deduct all the operational expenses like salaries, like depreciation, like rent, this sort of stuff. And then you get net profit before tax, and then you pay corporation tax on that. It can be, yeah, it is 19%. Yeah, and this is how the profit and loss account goes. And one thing we always need to remember is it must be dated. You need to put the date for that period that you are making the profit and loss account, we call P&L account. So it is very important that you date it, and it should always be on the heading on the top. And now I'll say why this is important, because it gives you the real picture of your business, that what you're doing, that you're investing your money, investing your time, investing your passion, investing your effort, everything, but what is actually giving it to you? Are you getting it back, that what you are really investing, or that? So this is how we do it. Like, we try to find out the gross profit percentage. So how we do it. So here you can see the numbers. The sales are 15,000 and cost of sales is 7,000. So once we take away 7,000 from 15,000, that leave us with 8,000 pounds. So this is our gross profit. So what we do is we do the gross profit divided by the total sales, and we times it 100, so gives us 53.33%. So this is our profit percentage that's we're making. So now you can see, with seeing this number in a forecast or in 1 year time, that are you making too much money? That's why your client base are not as with you like with some other people. Do you need to increase it? Do you need to decrease it? And then you can always, as well, you can apply this one in terms of pricing as well, that how much money you want to earn from the sales, by increasing or by decreasing it. And similar, here is net profit percentage, profit after tax, which is 4,730 pound, and you divide it, and then you get the total like net profit percentage. Then with this amount, you can check that are you paying too much overheads, like salaries, like rent, like insurance? Is there any way that you can cut down on it? Or are you paying too less to yourself? You can increase it a bit. So this gives you that sort of areas to think about, that what you can work on that. And then we have got in other expenses, which is here like depreciation. This is not an expense that you're paying to someone, rather you're paying it to yourself for a future purchase or something. So you buy a laptop. So we ideally say a laptop is for 36 months. So we life it for 36 months, and we divide it by 36 units, and we put every month, we deduct that much money from, so that will be another entry in there when we go to financial statement. So then we do it there as well. But here in the special, I keep it for profit and loss account. I'm not going there today because of obviously short time. So we put this amount as well. Like, so once after 36 months, you have the money to buy that laptop again. So your business is in hardship. It can be a car, it can be a machinery, it can be anything that fixed asset that will always need to be depreciated. So in future, you can buy it like this way. And then obviously we find corporation tax, and then we find our profit after tax. So I'm gonna keep this simple today, but obviously because we have not got enough time, we're going 4 minutes time. So in the meantime, if you have any question, anything, you can always contact us. You can contact Iona. But basic thing is you need to know your business, what's happening in there. And this profit and loss account will give you exactly that information. So I think I can pass over to my colleague and friend, Iona, now.
Thank you, Rashid. Thank you. It's always lovely hearing you talk about the profit and loss, and it always makes me, when I look at a profit and loss account, I look at all the things that are important for all of us to pay attention to when we are running a business. There is one point that I always want to make on a profit and loss account, is that number at the bottom, which says profit after tax, it's the one that you really need to focus on. It's that amount of money that will give you the freedom to pay yourself dividends if you want to, because dividends are paid on after the tax is paid. It's also that amount of money which will help you look ahead into the future and reinvest some of those profits into the business in order for you to grow your business and build a more sustainable business. So pay attention to it, and please don't be afraid of your numbers. The numbers are there to give you information, the information that you need in order to make decisions for your business. I hope we have managed to help you in that. If you have any questions, let me check. Okay, we have a question. I'd like to ask, how profitable should my finance report look? For example, if the cost couldn't be covered by the profit in the first 6 months, will it still be considered a feasible business idea? Well, I think that depends, and we haven't covered all the tools clearly today that you need to look at, but it depends a lot on your business. I think it is very easy to say, and everybody says that we should have a profitable business from day one. Personally, I don't think that that is the case, but very quickly, and that depends on the market that you are operating and the amount of cash that you have available in order to help your business grow in the beginning. It's variable. It depends, and you will have to check. You will have to benchmark it with your competitors. You will have to see a lot of different aspects. But
so, I'll just add quickly with this, and that's where what comes break-even point. So some businesses, you can't make money straight away from the first month, but obviously you got lots of expense things, and you can see the sustainability of a business with the break-even point. When is your break-even point? And from onwards, like, your aim should be that you are making money. So your business model should say that from that break-even point, your business should go up to the profitable
Yes.
steps, I can
I
say.
didn't
Yeah.
want to get into all of that because we didn't cover break-even points and we didn't cover our
Okay, yeah.
balance sheet and all of that today because we didn't have time. But the reality is that clearly the sooner a business becomes profitable, the better. But it is unhealthy to think that we should have profits from day one. And as long as we have targets that we are aiming and goals that we are aiming towards, and we have systems in place to help us check how we are actually doing against those targets, then I think we are in the right track. That's
Exactly.
all I can say for. Rosa Marie asks, can all fixed assets be depreciated on a straight line basis? And she says, thank you. I'll leave that for you,
Yes.
Rashid, because you're the.
Yes. So as I said, like, so your computer costs, like, say also £3,000, and as we said, we actually value it like 36 months lifetime. So you just divide it by 36, and so this is your each month's depreciation, and this should always be the depreciation. So after 3 years, you have got the same amount of money to buy the same laptop. So this is why, and it's for the machineries, it for your car, it for your everything. So
Yeah.
this is how you depreciate. It is straight line, yeah.
But I think the important note to make is that you really need to be able to work with an accountant. A lot of people say that an accountant is costly and that we shouldn't work with them from the beginning. I am saying that if you really want to have systems in place that help you track your business, you need to find an accountant that understands what you want and helps you build the systems that you need to have in place in order to track what is happening in your business. Sometimes it might not be necessary from the beginning, but I think that especially questions like that, you need to be able to talk with an accountant and see how they affect you for in your particular business. I don't see any other questions at the moment. If you have any more questions, please feel free to contact us. You will find all of our contact information in the Startups in London Libraries, British Libraries website, bl.uk/SIL. You will find all of our contact details there. Feel free to contact any of the champions. It's 10 of us around London. And also, don't forget our Startup Stars from Passion to Profit next week, a wonderful event that runs every 3 months, more or less, with fantastic motivational speakers and hands-on advice. It's an opportunity for you to be able to talk with people who have been there, have done that, and ask specific questions. Rashid, do you have anything?
I want to add something. Yeah. So this accounting, like as you say, lots of easy accounting, like 7-day accounting, 1-day accounting, lots of books and accounting. You'll find the local libraries. So if you go and borrow one, this will be free, and just go through them. This will give you a huge information, and you will understand everything.
Absolutely.
Like some books are very easy, like you just read once and you know the basics. And so once you know the basics, and then obviously your business grows and you can talk to an accountant. And there are lots of apps as well now, online accounts and everything, so you can subscribe to them, and though your account can be done like this. But
we have
always
less
remember,
than 1 minute.
You always remember to keep your receipts. So receipts are very important. I just wanted to add in terms of claiming any sort of expenses. So never ever lose your receipt. Take a picture.
Thank you, Rashid.
Take a picture, keep it. Thank you.
Thank you, everybody, for following us. And please stay on for the sessions that are following. Thank you.